Every single day, we're all just hit with the harsh reality of the world, right? You feel it in those rising prices at the supermarket, the painful cost of filling up your gas tank, and the pressure of your stressful job. And all the while, the media is throwing these massive, confusing buzzwords at you, things like inflation, GDP, debt, recession. It's fast, it's totally chaotic, and it honestly feels like it never stops.
So why exactly is your hard-earned money losing its value? Now, most people kind of just tune out when they hear financial jargon and don't truly understand how all these buzzwords actually connect to their wallets. But here is the wild truth. The entire global economy, every soaring stock market and every crashing price begins with one simple, incredibly strange problem.
Let's dive right in. Meet Coach Kobo. He's going to be our anchor for this explainer today. Coach Kobo knows that before we can even touch on things like big banks or global trade, we got to start with that one very strange root cause.
And that foundation? It's scarcity. Okay, scarcity simply means we live in a world with limited resources. Limited money, limited food, limited land, and limited oil. But, as you know, human wants are absolutely unlimited. Because stuff is limited, every single person, business, and government is forced to make choices. We actually call this making a scale of preference. Let's say you're pulling in $1,000 a month. You can't have it all, so you literally have to prioritize surviving over luxury. Step 1, rent. Step 2, food. Step 3, transportation. You are arranging your wants in order of absolute importance. But here's the kicker. Every single choice you make has a hidden cost. We call this opportunity cost. Think about, say, buying a pair of really expensive sneakers today versus throwing that cash into savings for tomorrow. If you drop your limited resources on those kicks, you are directly trading off against your future wealth. Basically, every financial decision is a trade-off.
Now, that makes total sense for you as an individual, right? But what happens when millions of people make the exact same choice at the exact same time?
Well, that brings us to demand and supply, the actual engine of prices. When millions of us want the exact same thing, it creates massive demand. But because of that scarcity we just talked about, businesses can only supply a very limited amount of that product.
So, when sky-high demand slams right into low supply, things get crazy fast. Suddenly, your everyday groceries that used to be a super reasonable $50, boom, they shoot up dramatically to $90. Stuff gets incredibly expensive for one simple reason. Everyone wants it, but there's just not enough to go around. Which brings us to the word we literally all dread, inflation. Inflation is just the general increase in prices over time. But the real so what here is how it absolutely destroys your purchasing power. That's how much your money can actually buy in the real world. Inflation is the exact reason why your salary suddenly feels like it's shrinking.
Moving on to banks and interest rates. See, when your purchasing power tanks, people still need extra money to survive or grow. So, where do they go? The bank. But, as we all know, borrowing money is never, ever free.
That hidden cost is interest. And interest rates affect literally everything. Your loans, your mortgages, businesses, everyday spending, and your investments. When the bank jacks up those interest rates, borrowing gets super expensive. And what happens then? People stop spending, which slams the brakes on the entire economy. It's wild.
Next up, taxes and government spending. The government actually has a massive influence on the economy, and they do it primarily by taking money right out of the system.
Taxes get pulled from workers, businesses, and goods to pay for the essential big stuff: roads, schools, hospitals, and security. And yeah, while those public services are absolutely vital, pulling all that cash out of the system takes a heavy toll on your personal spending power, and it really restricts how fast businesses can actually grow.
So put it all together. You've got super expensive borrowing, plus money constantly leaving the system through taxes. What happens when all of that economic growth just abruptly stops?
You get a recession. This is when businesses slow down, everyday spending drops, and unemployment shoots up. It is a really painful domino effect, guys. When folks lose their jobs and earn less, they buy less. And when they buy less, businesses struggle even more. It's a vicious cycle.
Which leads us to the global money machine. Look, economies don't just exist in a vacuum. Countries completely depend on each other through international trade to buy, sell, and swap vital resources.
And honestly, no resource is more critical than oil. Oil literally impacts everything: transport, food prices, Factories, electricity, shipping. Because the whole world runs on it, a supply disruption halfway across the globe will instantly hike up the price of goods right in your local neighborhood. Crazy, right?
But hey, it's not just about physical stuff, it's about the money itself. Exchange rates, which is just the value between different currencies, heavily affect what your imports cost. On top of that, if central banks decide to increase the money supply by pumping way too much cash into the system too fast, well, that just accelerates inflation even faster. So, to prevent a total global collapse, countries rely on something called the balance of payments and reserves. Basically, they meticulously track the flow of trade, investments, and loans moving in and out of their economy. They stash away foreign currency as an emergency fund, creating this international liquidity so world trade keeps flowing smoothly, no matter what panic is happening locally. Now, with billions of dollars, resources, and goods just flying across the globe every single second, you need a way to track who's actually winning and who's losing. And this is where things get really serious. Enter the ultimate scorecard, GDP, or Gross Domestic Product. It's simply the total value of all goods and services produced in a country. When GDP is growing, awesome. Businesses are expanding, jobs are popping up, incomes are rising. But when GDP weakens, you start to feel this crushing financial pressure spreading through the entire society. So at the end of the day, economics isn't just a bunch of boring math and confusing buzzwords. It is simply survival in a world with limited resources. It's one massive domino effect, starting from the scarcity in your own wallet to the opportunity cost of what you buy today, all the way up to global trade and oil shocks. Understanding this whole shebang really just reveals how our world actually works. So, I want you to look at your own scale of preference today. What hidden opportunity cost is quietly draining your wallet right now? If you found this explainer helpful, hit the like button and subscribe to Deez Finance for more simple explainers about money, finance, and the global economy.